You ever feel like just trying to invest is like, well, like bracing for impact sometimes?
Yeah, the market news can be all over the place, right? Ping-ponging back and forth.
Exactly. And so many options, it's easy to just feel, overwhelmed.
Definitely.
So today, we're doing a deep dive. We want to cut through some of that complexity. We're looking at a strategy that's really built for the long haul without needing you to watch the market constantly. It's dollar cost averaging.
Right, DCA. And at its heart, it's really about consistency. Forget trying to time the market perfectly.
So just investing a fixed amount of money regularly.
Yep. Same amount, same schedule, weekly, monthly, whatever works, regardless of whether the market's up or down that day.
Okay. So our mission today is to really get into DCA, how it works, why it's actually pretty good for anyone who wants to, get smart about this stuff without feeling totally bogged down.
And maybe understand why so many experts recommend it.
Yeah. And we're basing this discussion on insights from the Chris Invests YouTube channel, specifically their video, What is Dollar Cost Averaging? Dollar Cost Averaging Explained.
A good source for breaking this down.
So let's get into the nuts and bolts. How does this consistent investing actually work in practice?
Well, the core mechanism is that regular fixed dollar amount. That's the key. Weekly, biweekly, monthly. The consistency is what matters.
Okay.
And what happens, which is quite neat, is that your fixed amount buys a different number of shares each time, depending on the price.
Right, like that example people use, buying the same, say, chair every month. If the price drops, your fixed budget buys you more chairs, or in this case, shares.
Exactly. And fewer shares when the price goes up. It's this inverse relationship. You automatically buy more when things are cheaper.
It's simple but effective.
And, a lot of people listening are probably already doing this, maybe without even thinking about it.
How so?
Your 401k contributions, if they come directly out of your paycheck each period, that's usually dollar cost averaging right there.
Ah, good point. Okay. So that leads us nicely into the benefits, because it seems like there are quite a few reasons why this is, well, pretty popular.
There are.
I guess one of the biggest is taking away that pressure. Trying to guess the perfect time to buy in.
Absolutely. Trying to time the market perfectly,
Yeah.
buying at the very bottom, selling at the absolute peak, it's incredibly difficult. Maybe impossible consistently.
Yeah, I've heard even the experts struggle with that.
They do. The video touches on this, how you see wildly different predictions in the news all the time. DCA
Yeah.
it lets you bypass that whole guessing game. You invest regularly, no matter the noise. It avoids what some call a loser's game of market timing.
And it helps with the emotional side too, doesn't it? Because watching your investments go up and down can be, well, stressful.
Oh, hugely. That's a critical benefit. Market swings are normal, but they can trigger fear, right?
Right.
Panic.
Yeah, the urge to sell when things look bad.
Exactly, which is often the worst time to sell. DCA, especially if you automate it, builds in discipline. It helps you stay invested, stay the course through those ups and downs, rather than making rash emotional decisions.
Okay. And it sort of sets you up to benefit from those downs too.
It does, yeah. Because when prices dip, your fixed investment buys more shares. The video mentions this, how DCA lets investors sort of profit from market dips by accumulating more when assets are cheaper. Think about value invested principles.
Like buying something when it's on sale.
Precisely. Warren Buffett's success during the Great Recession is often cited as an example of benefiting from downturns, though maybe not strictly DCA. The principle of buying when others are fearful is similar.
And it's just simple, right? You don't need some complex algorithm.
Not at all. That's a
Ugh.
major plus. It's very straightforward. Most brokerage accounts let you set up automatic recurring investments. Super easy to implement.
Set it and maybe not totally forget it,
But largely, yes. It can run in the background once you set it up. Frees up your mental energy.
and I imagine it reduces that feeling of regret. Like if you invested a huge chunk of money right before a crash.
Oh, definitely. That's a big psychological win. Lump sum investing feels like more of a gamble on timing. Did I buy at the peak? Am I about to lose a chunk?
Right.
DCA spreads out your entry points. It lowers the risk of that single, poorly timed, large investment that can cause a lot of anxiety.
Okay, so the Chris Invest video had a specific example, right? With an index fund. Can we walk through that? It sounds helpful.
Yeah, it's a good illustration. So the scenario is investing $1,000 on the first of each month
Okay.
into a hypothetical fund, let's call it Index Fund XYZ, for 5 months. January through May. And crucially, the price changes each month. Let's say it starts at $20 a share in January.
Okay, so $1,000 at $20 a share. That's 50 shares in month one.
Correct. Now, February comes, and maybe the market dips. price drops to $16.
So the same $1,000 buys more shares now.
Right?
62.5 shares.
Exactly, 62.5 shares. Then in March, let's say it dips again down to $12.
Wow. Okay, so $1,000 buys quite a bit more, over 83 shares.
83.33 shares. Yep. But then things start to recover. April, the price bounces back to, say, $17.20.
Okay, so fewer shares this time, about 58 shares.
58.14 shares. And finally, May. The price goes up further, maybe to 23.38 shares precisely.
So $1,000 now buys the fewest shares yet, around 43.5.
43.48 shares precisely.
So 5 months, $5,000 invested in total. What's the outcome? How many shares did our investor end up with?
With adding them all up, they accumulated 297.45 shares over those 5 months.
Right. And what's the value of those shares at the end in May when the price was $23?
Okay, so 297.45 shares times 23 timers per share. That comes out to roughly $6,841.
Wow. So that's over $1,800 gain on the $5,000 invested, even with all that up and down in price.
That's right. And here's the key DCA part. What was the average price they paid per share?
Let's see. $5,000 invested divided by 297.45 shares.
Yeah.
It's under $17, like $16.81.
Exactly, about $16.81 per share, significantly less than the starting price of $20 and less than the ending price of $23.
Because they bought more shares when the price was low at $16 and especially $12.
That's the power of it. It averages down your cost. Staggering the purchases reduce the risk compared to putting all $5,000 in at $20 in January, or even trying to guess the bottom.
Makes sense. Okay, what about a different scenario? Someone suddenly gets a large amount of money, like an inheritance, or maybe they won the lottery, unlikely as that is.
Right. The windfall situation.
Is the advice still DCA, or should you just dump it all in at once?
Well, that's debated, but generally for most people, dollar cost averaging that large sum over, say, 6 months or a year is considered the less risky approach.
Why is that?
Again, it comes down to timing risk.
Yeah.
Putting it all in at once could be great if the market takes off immediately. But what if you invest it all right before a major drop?
Yeah, that would feel terrible.
Exactly. Spreading it out mitigates that risk. You won't perfectly time the bottom, but you also won't risk putting everything in at the absolute peak. It smooths the entry.
And what about all the talk you sometimes hear, recession is coming, hoard your cash? Does DCA argue against that?
It kind of does, yeah. The principle behind DCA suggests staying invested or continuing to invest is generally better long-term than trying to sit on the sidelines, waiting for the perfect moment or for bad times to pass.
Because you might miss the recovery.
You might miss the recovery, or you might just miss out on buying opportunities during the downturn itself. If you're consistently investing via DCA, a market dip just means your regular investment buys more shares at a better price.
So even if the market tanks right after you start, or while you're doing it, sticking with the plan is key.
Absolutely. In fact, those downturns are when DCA can really shine over the long term. Your fixed dollar amount gets you more ownership when prices are depressed. It lowers your average cost even further, potentially setting you up for better returns when things eventually turn around.
Okay, so pulling it all together then, for someone listening, maybe feeling a bit overwhelmed by investing, wanting a solid long-term approach, what's the core takeaway here about dollar cost averaging?
I think the main message is that DCA is a really straightforward and effective tool for building wealth over time. It shifts the focus from trying to be a market wizard predicting peaks and troughs to just being consistent.
Discipline over prediction.
Exactly. Set up a regular investment, automate it if possible, and let the strategy work for you. It helps manage risk, removes a lot of the emotional stress, and lets you participate in market growth over the long run. It's kind of a set it and get on with your life approach to a large extent.
So basically, dollar cost averaging is about that steady, consistent path. Navigating the ups and downs by just sticking to your plan of regular contributions, rather than sweating about finding the perfect time to jump in or out.
Precisely. And maybe a final thought for you to consider. Think about that principle. Consistent, regular action, even small amounts, repeated over time. How could that apply not just to your finances, but maybe other areas of your life? What could you achieve by just showing up consistently, even when it doesn't feel like you're making huge leaps? It's a powerful idea.